Hi guys, thank you very much for joining. So today we're going to be talking about what exactly is short selling, and this concept is very important from the CFA and FRM perspective. Okay, so we'll start with the basic question: what exactly is short selling? Okay, in a normal trade, what happens is that you have an intention to buy an asset because the asset price is going to go up. Okay, so you buy an asset primarily when the asset price is low. Okay, and you sell it when the asset price is very high. Okay, and that is because the intention is that you have to sell it because the asset price is going to go up, so you buy it low and you sell it high. But in short selling, exactly inverse happens. Okay, so you realize that the asset is overvalued and you sell the asset at a very high price and you expect the asset to go down. Okay, and then you go and buy that asset. So you want to make profit because the asset price is expected to go down, so you sell first at the high price, and when it goes down you buy it at a lower price. So in both the scenario, you are buying at low and you're selling at high. But in a normal trade, you're doing the buying first and selling later. In a short selling, you're selling first and buying later. Let us look at example with some numbers. Okay, in a normal trade, you will go and buy at say $100. Okay, and you expect that the stock price will go up, so you basically sell that asset at $130. That means $30 profit on each stock. Okay, so you were able to do that because you expected price to go up. Okay, but what happens in a short selling? You realize that is a stock which is overvalued, so you sell a stock at $130. Okay, and when it starts falling and it reaches a particular level, you go and buy that stock say at $100. So you make a profit of $30 per stock, but the intention is that you want to make profit when the stock price actually goes down. Okay, now how can you sell something when you do not have that asset? Because in a normal trade you actually own the asset first, but in a short selling you will sell that asset first. So how can you sell something when you do not own that asset? Let us understand the entire process in detail. Okay, so if suppose you identified a stock which is overvalued and you do not own that stock, so you will first go to a broker. That is a step one. You will borrow that stock from a broker. Okay, and once you have that stock, you go to the market, you sell that stock to some buyer in the market. Okay, that happened at $130. Okay, when the stock price starts falling and it reaches a level say $100, you again go back to the market, which is step 3, and you buy that stock from somebody in the market. And since you had already borrowed a stock from a broker, you will go back and give that stock back to the broker. Okay, so broker is actually assisting you in giving you a stock so that you can sell a stock because you do not own it. But in doing so, a broker will charge you a fees. Okay, so that is the cost that you have to bear for doing this entire transaction. Okay, now let's go and see what is the profit potential that you can see in the short selling behavior. Okay, when you do a short selling, you sell an asset at a selling price. That means you first get the selling price, and when you buy that asset again, you have to pay the purchase price, so that becomes your cost. And then again, when you pay the interest or fees to the broker, that becomes a cost. So the net profit is a consideration of selling price minus your purchase price minus the interest that is paid to the broker. Okay, let us look what is the maximum profit that you can earn and the maximum loss that you can bear. So maximum profit is when the stock price falls and reaches zero. That is a maximum profit that you can earn because of the selling. That's the selling price of that asset. But what is the maximum loss that you can see? The maximum loss is when the stock price goes to the infinity, because instead of falling, if the stock price goes up, then you have to face loss. Okay, so the maximum loss is unlimited at that because the asset price can go up to infinity. Okay, let us look at the payoff of a short seller and with an example. Suppose you saw Z Entertainment stock on 13th of April 2020 at a price of 137.10 rupees, and you realize that the stock is overvalued and you expect that the stock to go down in future, so you will sell that stock at the current price of 137.10, and the payoff of your stock will look like this. Okay, so do you realize when the stock price goes down, you will have a profit because you have done short selling. So profit is when the asset price or the stock price goes down, and the loss when the asset price goes up, as per the diagram, because it's an inverted diagram. Okay, so that's the payoff of the short seller. Okay, let us look at a case study. So there was a small businessman in Arizona which has around $37,000 in the brokerage account, and he saw one company, that pharma company, and realized that the pharma company is on the verge of bankruptcy and it might default anytime soon. So he decided to take a short position on the stocks of that pharma company. Okay, so stock started falling down, but immediately there was some buyer available in the market who decided to bought that pharma company, and because of which the stock price again started going up. And instead of the prediction that the small business owner was expecting that the stock price will go down, it actually increased and leading to huge losses to him. Okay, the loss was of $1,44,400. Okay, so that is a small case study, and the reason you need to understand this is that the short selling is not for inexperienced professionals. So because the profit or the loss can be unlimited, so you have to be very, very cautious in this entire process. So thank you very much, guys.